So, good afternoon and welcome to our presentation, an initial approach to optimizing insurance quotes with quantum computing. As Kendra already said, my name is Teske and I'm a senior IT consultant at MSG Insured. And together with my team, I support insurance companies by providing services for their web applications. And I first got to know quantum computing during my master's thesis on Sudokus.
Yeah, and thanks, Kendra, for introducing me. So I'm here, and what was the topic? Well, is in the daily life, I'm trying to digitalize insurance companies and close this gap between the actuarial department and the productive systems. And I think that's also where we got one question which brought us here, is that one major aspect in the risk assessment is missing in the moment. So we are quite good with our statistical models to calculate the risk with its own risk, but what we are not doing in the underwriting process, where you're in a sub-second time frame, is assessing the portfolio impact on one risk. We just underwrite all the risks and then afterwards calculate the correlations and calculate the diversification effects or the cumulative risk effects in the reinsurance process or in the risk mitigation processes at the very end, as these calculations just take too long, do hourly runs. And so when we're talking with the actuarial department, it is just that they do not even think about taking that into account for the underwriting process, as it's just currently taking too long.
And that is where quantum computing comes into play. So the term quantum computing describes a recent calculation method where computers which exploit various physical phenomena. Diving deeper into quantum computing would go beyond the scope of this presentation, but what is important for this presentation, greatly simplified, the use of these various physical phenomena makes it possible for quantum computers to handle many combinations at once, which leads to better calculation time. One category of quantum computing is called quantum annealing, and quantum annealing is especially designed to solve optimization problems, such as the aforementioned portfolio optimization problem. As I already had experience with the quantum annealer from D-Wave systems, due to my master thesis, we went with D-Wave systems, so we were able to hit the ground running.
So, but as long as we're here still on an actual congress, start with some hypotheses. So, hypothesis number one, an optimized portfolio is less correlated than an unoptimized one. The second one, which might be or will be important as we're using portfolio theory, we want to use the variance, but as we are more interested in the tail risk, we assume reduced variance leads into a reduced value at risk. The third one is we will define a utility function combining the risk we're seeing for the whole portfolio, or the value at risk, and the life cycle value of our risks. And if we optimize this portfolio, we would optimize the utility function for the whole portfolio. And hypothesis 4, more technical, is using quantum annealing should be significantly faster than calculating brute force in the classical way.
So let's have a look what we did to put the problem to the D-Wave and obtain a solution. So here we have an overview of all our steps we did. Starting on the top left, the problem to solve was defined. Then the problem was pre-processed. We encoded the pre-processed problem to a valid input for the quantum annealer, sent it to the quantum annealer for calculation, and then the output was validated and then encoded to a portfolio or solution. And finally, the solution was rated by how close it was to an optimal solution. And we will now have a look at each of these steps in detail in the following slides.
So, how do we start? We have an anonymized earthquake portfolio from an insurer with N risk. So, what are N risk in this? As we have a commercial portfolio, there were commercial buildings who could have different coverages with K different contract variants. So, what would that be? We could have a discount, we could have different discounts, we could have deductibles or limits. For our first approach, we just make it quite easy and we build a power set over these different variants. So we have, for example, for A, no discount, no deductible and limit, B, discount, deductible and limit, C, no deductible, no discount, no deductible and no discount, and D, discount and deductible and limit. So we just built a power set. Why do we do that? To normalize our set that we can binary code it and use that one to put it into our model. Because what we are doing next is to provide that one or use it within the quantum computer, we will go for an existing pattern. And the big advantage is that solving this optimization is following the same mathematics as getting to a minimum of the energy in an atomic system, so the so-called Ising chain. And, well, we have to transfer it a bit. And the big advantage is there are patterns already existing. So Grant, Humble, and Stump 2028, for example, did that in portfolio theory and as Markowitz formula for quantum computing, which we could use now, taking the variance from our physical model and taking the life cycle value as our expected return, optimizing that one following the Markowitz formula to the optimum for our outcome.
So let's have a look at the step input. As I said, we need to transfer this problem, now pre-processed, to a valid input for the D-wave. And to solve a problem with this quantum annealer, it has to be in a form of a so-called quadratic integer program. A quadratic integer program can be formulated as Ising or as quadratic binary optimization, short QBO. And we went with the QBO. A QBO is a triangular matrix, in our case with the size n times k by n times k, where n is the number of risks and k is the number of variants. After the pre-processing step, we have 3 QBOs. So for each part of this formula, the Markowitz formula we saw, we have 1 QBO, Q1, 2, and 3. And up to this point, it would be possible, or we would get some results from the D-wave calculated that include 1 risk in multiple variants. And this is something we don't want because 1 risk can only be insured once. So for this reason, we add an additional QBO, the Q4, and there is just this constraint modeled to prevent that from happen, or more precisely, to make it very unlikely to happen. So then we have a big QBO from summing up Q1 to 4, and we send this to the quantum annealer. And on the quantum annealer, the minimum is calculated. So quantum computing is non-deterministic. That means if you have the same input, you don't have always the same output. For that reason, we calculated 10 times, and then per QBO or per problem, and then we took the result with the lowest minimum as the best result. And for talking to the D-wave, we used the provided Python API, and as there are more than 1 concrete machine, we used Advantage System 4.1, which has around 5,600 qubits, where qubits are basically the bits of a quantum computer. As an output, we get, like we see here, a selection of risk variant combinations. So we see it here on the side. That's how it looks like. And in this example, we see 1B was selected, indicated by the 1 next to the 1B. That means risk 1 invariant B is selected. And now we make a validation. We first validate, did our Cubo 4 worked? So have we more than one variant per risk selected? That would be indicated if we if we have up here more than 1. No selection is also valid. And if we don't have a valid solution, then it is ignored. And then we check if the expected return is less than 0. If so, then obviously it's not a desired solution for insurer because it would mean loss. So these solutions are ignored as well. Our valid solutions are then decoded to a portfolio. That means in our example, we have again 1B selected, indicated by the 1 next to the 1B. And we transfer it back to, what does it mean? 1B is risk 1 with variant B, and B was discount and no deductible and limit.
So, right before we get back to our hypothesis, what are the results? The first one is, unfortunately, it only works on small portfolios. So when we talked about the qubits, there are a lot in the moment, but logical qubits are quite less. So it only works for small portfolios. We will see it later on. The second one is it works perfectly for the portfolio. So we have the optimization we could see. And third, it really is, compared to the time used in the classical computation, really, really fast. But get into the details. So the first one was hypothesis 1, the optimized portfolio is less correlated. We see here correlation matrix from 1 to 0, so we didn't have any negative correlations in our set. But from one correlation, extremely correlated, red to green, nearly uncorrelated. Yes, we could see that sometimes we really picked up this variance and this contracts to reduce the risk significantly. But to be honest, as we have a utility function with the return and the risk, of course, if there's a higher risk for significantly higher return, it might not be that we always minimize the risk. Well, but hypothesis 2, which was important, is what we can see here. It's more or less on the line, so we could say in generally reducing the variance lead to a reduced value at risk. And this brings us now to the more interesting results we could see next. We really see that our optimization worked. So what do we see here? For example, on the first box plot in red, you see the ratio from the optimized to the non-optimized portfolio, the average portfolio we would have without optimization. And for a portfolio with 5 risks and 4 variants, we had in average a 42% optimized solution in our utility function. Well, as expected, as the quantum annealer is not deterministic, it will be harder to get good results the bigger the portfolio gets. So we got a decrease for the 20 risks with 4 variants. So we had the option to do some parameter tuning and got better in our results with 50 contracts and 4 variants. So it's a bit, you see, why didn't we calculate it again, the 20 risks? Well, it has something to do about the time we had on our D-Wave systems. But what do we see with 50 contracts and 4 risks? We had an average 18% better results in the utility function. So there is a significant optimization compared to the non-optimized results. Well, let's see it a bit more in detail. And we could have a look on the 5 risks for variance. Why are these small sets or portfolios? Because with these small portfolios, we are able to calculate brute force the optimal portfolio as well. Took a time, but we could do that. So what do we see here? No, it's not the movement of the troops of Hannibal crossing the Alps. It is our results with no optimization, the quantum result, and the calculated optimum on our map having the expected return on our life cycle value and the value at risk over the whole portfolio. So what would be better? It would be better if we're going from somewhere here up to the upper left corner. That would be a very good result, and here we have nearly an optimum result where the quantum annealer matched the calculated optimum. Well, it's a lot to see, so let's switch to the left side where we have the average of all results, and we see, oh yeah, it really did a good job. So we went from the average portfolio, no optimization, to the upper left corner, a quite good way to the optimum, which would be calculated with our result. And this allows us now to get to the calculation time. So did we really have an advantage in our calculation time? Well, in our small set, we really could see that the calculation time only developed linear, which would even be better than that what would be theoretically expected. But when we are looking here, we are here for a portfolio with 7 risks and 4 variants. We are in some hours calculating that. And the quantum annealer took also for the biggest portfolios we had about 16 seconds. So yes, we're right away from the sub-second I was talking at the very beginning, but we're in the moment where you could talk about, for example, for commercial risk or something like that in the underwriting process, that it could be acceptable to take that into account.
So what did we see in this presentation? Insurance portfolio optimization was successfully formulated as QUBO, and we saw an initial case study showing the feasibility of solving said QUBO with a real quantum annealer. Let's have a look at the next steps. Next steps could be further parameter tuning. On one side, tuning the Q4 so that we get more valid results, and tuning the Q1, 2, 3, that we can get better results. And there's also the possibility to tune the input parameters from the D-wave. We also could improve our implementation to be able to solve larger QUBOs. And an interesting part could be the analysis of the influence of different aspects in the portfolio, such as the geographical distribution, if they have any impact on the results, and if there are better or if there are portfolios that work better or worse for the optimization. So what should you take home from our presentation? Quantum computing is still arriving in businesses, and there are first attempts of using it, for example, in the area of optimization. But on the other hand, it's still in its early stages.
So what does this mean for us actuaries in special? Well, it is good to be prepared and know that there is something like quantum computing, that there's something coming. Do we need to rush? No, it's in the early stages, and as we might see here, we are in the moment with some portfolios, and even if we could, with optimizing our parameters, we could get to a portfolio of about 100 or 200 contracts or something like that. I think we are still far away from optimizing a whole insurer portfolio. But it is there, and it is there for some use cases. So as well, it won't change the whole thinking of our IT systems. Quantum computer is usable for special problems, like, for example, the optimization we just showed in our case study. So, long story short, we hope you liked it. Just for the credits, our references for the pictures we had. And now I think we're waiting for your questions, your remarks, your experience with quantum computing so far. Thanks a lot.
Thank you.
Thank you. So if you have any questions, you can submit them on the app, and they'll come through magically to my iPad. Or we have a microphone if you have any questions out loud. Does anyone have any? Okay, I have a question here. It says, do you see applications in optimizing a portfolio of
Microphone's
products?
coming.
Right?
Yeah, but we will hear it from you.
Effectively use case that you use, that was within a product itself, so it was a commercial insurance, risks within a commercial insurance product. Do you see applications in using this across products, so optimizing portfolios of products?
Well, I think that in the moment it's not in production anywhere. Yeah, you could use it in portfolio optimization, and yeah, there are at least some attempts using it in portfolio optimization in the market portfolios, so stock portfolio, investing portfolios that is used. But I would say also for cross products, of course, you could use it, and that might be also a use case really using it. Is as we said, that the set is quite small in the moment, but for the personal offer, you could use that, taking all the products you're having and optimizing how to present the products, in which way presenting your products. And there, of course, cross all lines of business from health, life, and P&C insurance.
You have another question up here in the front?
Well, that was the question of the modelization. So if you have different, then that would be just more variants. If we introduce there's a variant limit 1, 2, 3. So what we want to have is a discrete set of variants. And then you just could as well optimize it for the perfect limit, for the perfect discount, for the perfect setup per contract, yes.
Any other questions from the floor?
In the last row.
Oh, one way at the back.
Would you use the app? Thank you. So it was great to see how quantum computing can reduce the time of processing. What would you say would be the additional costs, like processing costs from the computing hardware or the server from that point of view? And also, the second question is, what do you think needs to happen for quantum computing to be more accessible for insurers?
So perhaps I start with the question 2. It is already accessible. So I read something from D-Wave where they say it's already there and we have commercial quantum computing is already possible, and it's just because the other companies are not that far at the moment, and that's the reason why they say it's not possible at the moment. But we need to be careful because there are 2 parts of quantum computing. You have the gate-based quantum computing and you have the quantum annealing. And we showed quantum annealing, and you cannot directly compare, for example, the number of qubits in the calculation power when you have it with a quantum annealer or with a gate-based. So I learned today it's a typical actuarial answer. It depends who you ask and which type of quantum computing you are looking at and which problem. Yeah, and the question with the costs was one we already discussed. I don't know, you have an idea?
No, so for our case study, you have the option to use it for free in a non-commercial way, where you just also provide your codes to the public. You can use it for free. So we didn't ask for the commercial costs, which has to be discussed with D-Wave. I think they have a rate card or something like that. So I'm sorry.
Yes, but from the accessible perspective, everyone can use it. So you can go to the website, you registrate, and then you use it. You can try quantum annealing with D-Wave, but you can try also the gate-based model. It's all accessible, and yes, you just need to be curious about learning it and trying it out. I think it's really interesting that you can just go in your browser and talk to a quantum computer somewhere.
And there's one aspect, I think, which is also, which maybe we showed a bit. It is getting a step further from that you really have to bring together an actuary and a computer scientist and a physics PhD to handle that, because there are now some pattern existing, and you can set up on the existing pattern. So it's not that you have really to go to this very basic step where you're defining, especially for the gate-based quantum computing, where you have to get through it. What are we doing here? How to define our fee or something like that? And honestly, I'm out on that point. And that's the advantage, that you have more and more pattern where you can set up on.
Right, I have a couple of questions submitted on the app, so we'll just do those. So the biggest challenge to quantum computing is changing the mindset from deterministic to probabilistic. How did that impact the way you built the algorithm?
The question was,
What was the question?
The question was, how did it impact that it's not probabilistic?
From deterministic to probabilistic.
Yeah.
Yeah.
It's not deterministic, thanks.
Yeah, it's always a little bit like having luck if the 10 times you're calculating are good or not. So I don't know if it's really had some influence on the algorithm, because we didn't really do an algorithm with the quantum computer. We just prepared the data, and then the pre-processing step was finished, and then we sent it to the D-Wave. But yes, then we get some results back, and they were really bad. And I said to Matthias, okay, you did something wrong. And then he tried again, and no, it did not work. And yeah, and then first I thought it was Matthias' fault, but it was not. So then we tried this parameter tuning, and then we see, okay, if we change here a little bit and there a little bit, then suddenly magic happens and it works. So there are a lot of papers about that parameter tuning in quantum computing is, as said, the biggest challenge, because mostly it's not really understood, and it's, to be honest, really complicated to get through all this. So I think that's the part that influences it, that we did a lot of tests. So we tested, rerun, and so this parameter tuning is a big, big issue.
I think we did it a bit like the other big topic, AI. So you have a training set, and you just train your data there, or prove your data against this training set, and then if you say, okay, now we're confident on it, we can do it on our test set then again. And that's a bit how we did it. So yeah, try and fail.
Okay, one last question, thank you. Says, the variance of the quantum output introduces a new complexity. How can this be controlled going forward? It might just destroy all the parallelized gains.
Paralyzed gains.
They destroy or parallelized gains?
I think one thing that is a little bit misunderstood is that the quantum computers are not doing something new or something special, or we will not solve all problems with quantum computers. I personally believe that the best way will be, and for example with the D-Wave we didn't try it out, but that would be one next step. There are some attempts to use parallel different algorithms. So use machine learning for one part, and then use quantum computing for just a specific part where it fits best, and then some normal algorithm. So, and then combine them and then get the best result. So I don't think it will destroy something, but I'm not really sure if I got the question right. You want to read it too? So. Where is it? Do you have the feeling we answered the question?
I think so.
Okay. Perfect.
Thank you.
Or we'll discuss it afterwards.
Well, thank you very much.
Thank you.